joint Moody's and ICRA webinar where we'll try and answer the question, is the cycle turning for the steel makers? My name is Vikas Halan, and I'm an associate managing director with Moody's Investor Services, looking at corporate ratings in Southeast Asia. Let me introduce the panelists for today. We have from Moody's, Kaustubh Chawal, who is a senior vice president. From ICRA, we have got Ritubrata Ghosh, vice president and sector head of corporate sector ratings at ICRA. Priyesh Ruparelia, vice president and co-group head of corporate sector ratings. And last but not least, Jayanta Roy, senior vice president and group head of corporate sector ratings. Now, as we enter into or near complete 5 months from the Russia's invasion of Ukraine, we have started to see easing up of some of the supply constraints, and impact on supply chains is starting to moderate. At the same time, we are seeing more macro impact of the high inflation. We are seeing the effect of sustained high commodity prices and a slowdown in economic growth, particularly in China, how that is affecting the demand side of things. So all of these factors are having impact on most commodity prices, which went up to a very unsustainable level not too long ago, and most of them have started moderating again. Now, what does this mean for the steel sector? Is the story different in the global context? For that, we have Casey, who will cover this and a lot more in his opening remarks, which will then be followed by Ritubrata, who will talk more on how this is playing out for the steel sector and what are some of the specific factors for the steel sector in India that we should look out for. So we'll cover this and a lot more in our prepared remarks, which will be covered by Casey and Ritubrata. The prepared remarks will take about 30 minutes, which will then be followed by a Q&A session. We'll have enough time for the Q&A. But if you want to raise any question in the meantime, please use the Q&A box on the screen, and you can type in the question, and as questions come in, I will build up a queue, organize them in different topics, and then post to the panelists. So without further ado, let me hand over to Casey to go through his prepared remarks. Casey, over to you.
Thank you, Vikas, and good afternoon, everyone. So as Vikas said, for most part of 2021, steel prices globally remained at all-time high levels, enabled by strong underlying demand. The improved economic performance was the result of rapid vaccinations, a relaxation in curbs caused by the pandemic, massive fiscal support, as well as robust consumer spending, which all of these factors cumulatively leading to improved business activity. Now, the Russia-Ukraine war certainly created steel supply constraints, especially in Europe, since Russia and Ukraine were among the leading exporters of finished steel to Europe before the conflict. Russia also represented the largest share of energy exports to Europe. As a result of this conflict, therefore, there were significant supply disruptions and upward price pressures and volatility in the prices of steel, coking coal, and iron ore, as can be seen on the three charts on the slide. We'll use China domestic HRC price as a reference here, also because the Moody's price sensitivities on steel for the region bases this benchmark. The international iron ore price is plotted in the chart in the center as a reference, but we note that domestic iron ore prices do not necessarily follow import parity pricing. And the last chart plots the prices of coking coal, the other key steelmaking input. Now, a common theme across the three charts is the recent softening in the prices of all three commodities. So it wasn't just steel. Coking coal has now returned from its peak of over $600 to around $250. As such, limiting the impact on product spreads from the softening steel prices. And steel prices in India corrected in May and June following the imposition of tax on the export of various steel grades, wherein the tax levy was levied with an overarching aim of reducing commodity price inflation. So the domestic steel prices, we believe, will remain rather subdued through September. This is also a seasonally weak quarter due to the monsoons, wherein the pace of infrastructure and construction activity typically slows down. We have one consolidated industry sector outlook for the global metals and mining and steel industry here at Moody's. And our ISO is stable for the sector. The last ISO was published in June this year, and the stable outlook reflects our view that credit fundamentals for the sector will remain largely stable, despite an aggregate EBITDA decline. So for the ferrous metals cohort in particular, as we also discussed earlier, prices have already started to soften. As the Russia-Ukraine conflict lingers, it will have second-order macroeconomic effects on global growth rates, inflation, and monetary policies across various countries. To add to that, China's lockdown on account of the new COVID-19 cases, climbing global inflation would also cause GDP growth to somewhat slow. The Reserve Bank of India has already raised the benchmark repo rate by 90 odd basis points in May and June. And our own macro board has revised downward the GDP growth forecast for India to a little less than 9%. It is 8.8% for 22, down from an earlier estimate of 9.1, while we've maintained 2023 GDP growth at around 5.4% to be precise. Overall, we expect steel consumption growth in India to slightly moderate to the high single-digit percentage terms during fiscal 23. And this follows an increase of around 11% last fiscal year in fiscal 22. As to ESG, in terms of environmental considerations, the steel sector has high risk, especially in relation to carbon transition and waste and pollution. And while overall social risks, we consider them to be moderate, and they mirror the scores for human capital, responsible production, and demographic and societal trends. The high risk stems from health and safety risks for steelmakers' employees, given the rather intricate steelmaking operations. Moving on to our portfolio of rated global steelmakers. Globally, we rate some 19 steel companies. This number does not include the aluminum processors and alloy companies that are also rated under the steel industry methodology. There have been several positive rating actions in our steel portfolio over the last 12 to 15 months. The high steel prices, handsome spreads, along with the robust demand, has translated into large free cash flow for the cohort. And many companies have applied this large free cash flow towards absolute debt reduction, thereby structurally improving their balance sheets. Of the 19 rated steelmakers, we have 3 companies that are on a positive outlook. This includes Tata Steel at BA1, BlueScope at Baa3, and Cleveland Cliffs at BA3. We still have 2 companies that are on a negative outlook, that is InfraBuild at CAA1. That's due to imminent refinancing risks associated with their 250 odd million asset-backed loans, ABLs, that are due in October this year. And then there is Turkish steel producer Erdemir, which is rated B2, but their negative outlook mirrors the negative outlook on the Turkish sovereign, which is also rated B2. The balance 14 names that we rate in the steelmaking universe are on a stable outlook. I wanted to conclude my prepared remarks by talking about the relative positioning of the Indian steelmakers with their international counterparts. On this slide, we compare Tata Steel and JSW with the investment-grade steelmakers that we rate globally. The size of the bubble represents revenue. On the vertical axis, we measure profitability in the form of EBIT margin. And on the horizontal axis, we're looking at debt to EBITDA leverage. As you can see over here, both Tata and JSW have among the highest levels of profitability and have low leverage, but their relative size is actually small as depicted by the size of their respective bubbles. And on this last slide, we present the same analysis, but now we compare the rated Indian steelmakers with the high-yield steelmakers. Note that we've included Hyundai and JFE in this cohort, despite the investment grade ratings. That's because we view their underlying credit profiles in the high yield universe, but their final ratings incorporate uplift, which takes them to the other side, and they are rated IG. Now, when we compare the Indian steel makers with the high yield universe of our globally rated steel makers, the Indian steel makers do stand out as being the most profitable ones and with leverage lower than many of the peers on this slide. In fact, Tata Steel is on a positive outlook at BA1, so it is already on path to be rated investment grade. That concludes my prepared remarks. And with that, I'm going to pass on to Ritubrato for his prepared remarks.
Thank you, Kaustav, for giving us a detailed perspective on how the global steel industry has recovered following the pandemic, and also how the Ukraine conflict have exposed steel companies to unprecedented energy cost inflation. Indeed, we are going through an interesting phase of the global economy, wherein, on one hand, we are seeing how an overstimulated economy in the US has taken inflation to a 4-decade high. Whereas on the other hand, we are also seeing how China's alternative approach of a strict zero COVID policy had the unintended effect of bringing down the country's GDP growth rate close to zero in the second quarter. What is, however, ironically common is that the solution to tackle the problem of COVID being adopted by both these countries have changed the nature of the problem, with the Fed now trying to slow down an overheated economy, while China trying to do the exact opposite of stimulating its economy back to shape. While the business sentiment was quite upbeat 6 months ago, the scenario has changed quite perceptively since the war broke out in Ukraine. As Kaustav has highlighted in his opening remarks, the disruptions in the global energy and food supply chains has made the economic outlook more uncertain in financial year 23 and beyond, increasing the chances of mean reversion much earlier than anticipated. All the leading global steel consuming hubs have seen a downward revision in their GDP forecasts. This suggests that the road ahead could be much bumpier for steel companies in financial year 23 than the year gone by. We have a 6-point agenda for today's discussion. Broadly, we have split our presentation into 3 sections. The first section covers the key trends that are emerging following the imposition of export duty. The second section highlights the long-term drivers of steel demand in India. In the last section, we would talk about the financial year 23 industry outlook. Our first slide takes a look at the recent development, which Kaustav has very briefly touched upon, and which has made steelmakers feel the heat. On 21st of May, in an attempt to rein in inflation, the government imposed a 15% export duty on a range of finished steel products. An export duty of 15% has also been levied on pig iron as well. On the raw material front, however, there was some good news, with the government increasing the export duty on iron ore and pellets to 50% and 45% respectively, and simultaneously withdrawing the import duty on coal and coke. These measures have provided some relief to steelmakers, especially on iron ore, which corrected by over 30% since these announcements have been made. As steel is a globally traded commodity, in periods of weak domestic demand, large steel mills have demonstrated the ability as well as the flexibility to allocate a greater share of the production towards exports. This has supported capacity utilization levels as well as overall earnings. Europe, Vietnam, and the Middle East were the 3 largest destinations for Indian steel exports, accounting for a share of around 50%. These duties have targeted over 90% of India's overall finished steel exports, and therefore we believe that from now on, exports become a much less attractive proposition. Consequently, we expect India's finished steel exports to decrease by around 25% in financial year 23, with the decline likely to be more pronounced in highly competitive markets like Southeast Asia and the Middle East compared to Europe, where the export offers typically are much higher. Interestingly, the government has chosen to keep steel semis out of the ambit of export duties. Therefore, we believe that export of semis, which declined by around 25% last year, is likely to witness a significant increase of around 40% in the current fiscal. Steelmakers could also explore the possibility of switching to export of value-added alloy steel categories, which are outside the ambit of duties as of now. With the leading domestic steelmakers having an export share ranging between 15 to 30%, competition in the domestic market has naturally intensified as companies look to divert part of the export volumes to domestic users. Not surprisingly, domestic HRC prices corrected by around 10 to 15% since the imposition of the duty, and further cuts in the coming months cannot be ruled out as demand remains soft in the seasonally weak monsoon quarter, when the share of exports are typically much higher. On the import front, with competition heating up in the domestic market and with domestic HRC currently trading at a discount of over $50 over the landed cost of imported offers, domestic mills would target to partly substitute the import of commoditized steel grades, and this is expected to lead to India's overall finished steel imports contract by around 10% in financial year 23. Given the macroeconomic headwinds and energy cost pressures, steel companies were stuck between a rock and a hard place in the first quarter, as the operating environment was not as conducive to be able to entirely pass on the cost escalations. Our next slide joins the dots between the trends in steel prices and input costs. With the domestic HRC prices on a downtrend since the imposition of the export duty, and with coking coal consumption costs poised to spike by around 30 to 35% quarter on quarter, thanks to the lag effect of around 2 months, the industry's operating profits are expected to sequentially decline by as high as $100 per ton in the first quarter. While the margin pressure is likely to persist in the seasonally weak second quarter as well, the correction in coking coal prices by around 55% in the last 2 months augur well for steelmakers' second half margins when the demand conditions are expected to improve. The next few slides take a look at some of the mega trends that will drive domestic steel demand in the foreseeable future. The first secular driver is the government's strong infrastructure push, which has seen the capital spending by the central and state governments grow at a healthy CAGR of over 14% over the last 1 decade. In financial year 23, we can see that the central and state government infrastructure spending is slated to increase by around 22%, and for the first time is poised to reach the annual capex run rate targeted in the National Infrastructure Pipeline, in short, the NIP. While government capex spending has been very encouraging, the participation from the private sector has been lacking so far largely, and despite some green shoots in areas like renewables and chemicals, there is significant catch-up to do in most subsectors so as to meet the NIP targets. However, we believe that the PLI scheme could change the trend going forward, as the government has announced large incentives that could spur investments worth around 4 lakh crore in 14 sectors, most notably in auto, electronics, energy, and farm. Within the infrastructure complex, affordable housing, water infrastructure, and transportation has been key focus areas for the government, all of which are very steel intensive. If you look at the housing sector first, allocation to the flagship Pradhan Mantri Awas Yojana scheme have seen a twofold jump in allocations compared to the pre-COVID years, and with around 50% of the targeted urban households being covered so far, the funding momentum is expected to continue over the next few years. Now, looking at the allocation to the Jal Jeevan Mission, the funding has increased by 6-fold since financial year 21, and with only 50% of the targeted households having received tap water connection so far, the government's funding lines in this scheme is not going to run dry for the next several years going forward. Another secular trend we are seeing is the quantity to the quality shift in India's transportation infrastructure, as national highways, expressways, dedicated freight corridors, high-speed rails, and metro rail projects increase the speed of mobility, and station redevelopment projects improve the quality of passenger experience. The pace of highway construction have seen a threefold increase since financial year 14, and capital spending by the Indian Railways is now over 4 times the levels that were there in financial year 14, and this was also the year when there was a change in the government at the center. Now, focusing on the consumption side, in developed economies like USA, Europe, and Japan, where the motorization rates are among the highest globally, the automobile sector accounts between 18 to 28% of the country's steel demand, as against a much lower 8 to 10% for India. However, India's young demographic base and expanding middle class and improving quality of road infrastructure is expected to support a secular increase in auto demand in the foreseeable future, which augurs well for flat steel players as well as alloy steel players. In the next slide, we look closely at the relationship between India's steel intensity and the income levels per capita. The amount of commodities that a country consumes is for the most part a function of two very simple factors: the number of people in the country, firstly, and secondly, the average income levels per capita. The relationship between commodity demand and income levels isn't a straight line, however. As long as a country's annual per capita income remains below $400, which is in the lower middle income zone, people spend most of their income on the basic things needed to survive, like foods and clothing. What's more, governments of lower middle income countries often do not have the adequate resources to invest in a big way in public infrastructure assets. However, after the per capita income rises above $400, crossing over to the upper middle income zone, countries typically industrialize and urbanize at a more rapid rate, creating a strong and sometimes disproportionate relationship between further economic growth and extra commodity demand. India is expected to hit the commodity sweet spot of $4,000 per capita GDP towards the later part of the current decade. Expecting that this crucial transition would accelerate the country's steel demand in the next decade, starting 2030, steelmakers have lined up large expansion plans accumulating to around 130 million tons per annum, which would entail a capital outlay of approximately $70 billion. That said, the pace of execution for some of these expansion projects could slow down if the export duty is maintained over the medium term. If we try to take a look at the World Steel Association's global steel demand forecast, we see that following the Russia-Ukraine war, the agency has revised the global steel demand growth for the current year to only 0.4% now. The downward revision can be seen to be more severe for USA and the Euro region, with the latter now pegged to witness a contraction in steel demand in the current year. India appears to be the only bright spot in the pack, with its steel demand being marginally revised upwards. Given India's low per capita steel consumption of only 75 kg, which is 1/3 of the global average, and the government's strong push for infrastructure investments, India is poised to become one of the fastest growing major steel markets globally over the medium term. Now we come to the last section of our presentation, which is on the financial year 23 industry outlook. Given the uncertainty about the future course of the global economy, we have looked into 3 possible pathways that could have different outcomes on the performance of the steel industry in 23. In the base case scenario of a soft landing for the US and Europe, we have pegged the industry's operating profits to slip to around $135 per ton in financial year 23, lower by over 50% compared to financial year 22 levels. On the contrary, in the pessimistic scenario, if the Fed's monetary tightening measures and a prolonged Russia-Ukraine war pushes USA and Europe into a recession, then the industry's operating profits could fall even lower than $100 per ton. The third scenario that would emerge is the optimistic case of a rally in steel prices following a large Chinese stimulus in the second half of calendar year 22. On this front, we have seen that China recently announced a fresh round of stimulus measures to stabilize the economy after it eased the 2-month lockdown restrictions, which envisages an accelerated pace of infrastructure spending. An increase in stimulus spending carries the potential for stimulating Chinese steel demand, as we have seen in calendar year 20 and the early part of calendar year 21. In a base case scenario, while the domestic steel demand growth forecast for 23 has been kept unchanged at 7 to 8%, the industry's overall operating profits for the current fiscal is revised downwards by around 30% compared to the previous estimate made before the Ukraine conflict. Following this revision, the industry's base case operating profits in 23 is expected to now remain in the stable zone range of $100 to $150. Consequently, we have now downgraded the sector's outlook to stable from positive earlier last month. Now, moving on to the operational matrices, one interesting data point that can be noted here is that the industry touched the magic 80% utilization level mark in financial year 22 after a long gap of 7 years. A capacity addition of only 3 million ton from NMDC is expected this year. Notwithstanding the export market challenges, incremental domestic demand is likely to absorb this limited supply coming on stream, and the industry's capacity utilization levels in the current year is therefore expected to improve further. However, the improvement would be unevenly split between the larger and the smaller mills, with many of the now smaller mills facing challenges to cope up with the surge in imported thermal coal prices and a scarcity in domestic coal availability. In the next slide, we look at a very important factor which we believe would give steel companies the resilience to withstand a significant deterioration in the macroeconomic environment from where we stand today. The first metric we look at is the industry's consolidated bank borrowings, which is now at a decadal low. The picture is even more revealing on looking at the consolidated bank borrowings per metric ton of installed capacity, which currently stands at around $160 per ton, which is around half of what it was in the pre-Lehman period. While steelmakers have lined up large expansion plans to be executed over the next 1 decade, with the industry's debt levels being lower by around 30% over the pre-pandemic levels, the balance sheets of most steelmakers would continue to remain comfortable over the medium term. This slide gives a forecast on industry's profitability and leverage metrics. Given the pressure on margins, the industry's business-related indicators for financial year 23 are likely to moderate to financial year 21 levels. With 2 back-to-back years of strong performance, the leverage metrics of the domestic steel industry witnessed a significant improvement, with total debt to operating profits reducing to just 1 time in financial year 22. In 23, however, with the upcycle now showing visible signs of fading away as earnings moderate, this has the potential to directionally exert a downward pressure to the industry's leverage ratio, which is expected to increase to around 1.5 times. However, this is still much lower than the pre-pandemic levels when it was at around 3 times. With this, we come to the end of our presentation and would now hand over the microphone to Vikas for starting the Q&A session. Over to you, Vikas.
Thank you, Ritabata. That was excellent and very comprehensive, talking about all the 3 aspects that you outlined in as comprehensive manner as you've done. I'm sure this has stimulated the thought process for many, and we should have a lot of questions coming in. So we will now go into the Q&A session. Thank you all presenters, and then we will get to the questions as they come in. I will try and bucket them into the topics that we have outlined. So the export duties on one hand, overall industry outlook, regional industry outlook, and then the India long-term drivers and any of the short-term drivers or short-term outlook. So let me bucket them into these 4 categories. If you want to know how to ask a question, just type in the question on the Q&A. Just click on the Q&A box at the bottom, or the button at the bottom. It will open up a screen where you can type in your question. So let me give Ritabata a bit of a breather, and let me first go to KC and talk about the impact of export duties, KC, and on the 2 rated steel makers that we have, Tata Steel and JSW Steel, and how have we factored in this impact of export duty? Which one is going to be more impacted by this government action?
Sure. Thanks, Vikas. So our forecasts for the steel makers are based on long-term sustainable levels of end product prices as well as those that of inputs. So we've modeled around a 30% odd reduction in EBITDA per ton for Tata Steel, and for JSW it's around 35 odd percent reduction over full year of fiscal 22. Now, even though JSW has a larger installed crude steel capacity in India, Tata Steel sells more steel in India. So, for instance, during fiscal 22, Tata Steel sold some 15.6 odd million tons of steel in India, which translated into a 15 odd percent market share, while JSW's market share in India was 12 odd percent with 12.8 odd million tons that they sold. Now, which implies that they have a higher dependence. JSW has a higher dependence on exports, and therefore they are more vulnerable to challenges. As they would need to increase their domestic sales volumes to the extent that they would want to reduce, exports in light of these export taxes. So JSW exports around 25 to 30 odd percent of the steel that they produce in India, whereas for Tata Steel the ratio is around 10 to 15 odd percent. So we believe that while some exports will yet continue for both companies, the export taxes mean that a similar export mix as the previous year is unlikely to be maintained. So they would likely have to divert part of their volumes to the domestic market, and since JSW has to divert more to the domestic market, and therefore they're slightly more vulnerable.
Thanks.
Vikas, back to you.
Anything Jayant or Ritabrata or anyone wants to add to that question? Maybe I can broaden that in terms of export taxes and how long do you think these export taxes will remain in place now that the environment is softening a little bit? Do you think the government will take steps to address this?
Ritabrata, yep, you want to go ahead?
Yeah, sure. Thanks, Vikas. So first of all, to answer the question, let me try to look back in history. What happened when last time the export taxes were announced? That was in 2008. The duty was there for around 5.5 months. So it was imposed in the month of May. It was withdrawn in the month of October. So it has a very limited shelf life then. But in those 5 months, a very critical thing happened was that Lehman defaulted. And from $1,000 per ton of Chinese HRC prices slipped to around $550 per ton. And that was also the period when government withdrew the duty. So today, as we speak, yes, steel prices have corrected quite visibly from the peaks of $1,000. Currently, Chinese HRC is around $650, $660. But still, it is significantly higher compared to the long period median levels of around, let's say, $550. So in the market, there are two line of thoughts. One is sooner rather than later, the duty will be withdrawn, given the fact that steel industry is one of the major contributors of export earnings and also is a very critical industry per se. And with the operating environment being much weaker, obviously, steelmakers would need the exports to kind of make ends meet. So that is one line of thought. And to that extent, duties could be withdrawn anytime soon. In fact, a couple of media articles have, alluded to that fact. But from our perspective, I think it is very difficult to kind of prejudge when the duty will be withdrawn. But on the positive side, we are seeing that inflation worries are, at least the numbers are suggesting that it has kind of peaked. Inflation peaked in April. The May numbers have come in, the CPI numbers. It is marginally lower at around 7%. And the RBI's upper threshold is 6%. So if this trend continues, obviously, we could be in a better position to kind of get a sense about when the duty could go away.
Thank you. Okay, so we talked about some of the export duty impacts and how long it was going to last. I'm getting a few questions on some other macro or global trends that may affect the Indian market. Maybe start with Casey on that, talks about the global trend. So one, of course, and the question is from 3 different geographies. So let me go one by one. The first one is Russia. How much threat does Russian exports are to Indian steel prices?
So, I mean, India imported some 5 odd million tons of steel last year. So, to the extent, and I just read that, some 156 odd thousand tons of, steel orders were placed, from Indian, traders. So, to the extent that steel continues to be imported into India, or, any new orders being placed from Russia, that becomes a threat. But then also there's the issue of the currency, right? So, the Indian currency is depreciating, but that needs to be seen in context of what happens with the Russian ruble as well. So while the Russian, steel makers may be offering some certain discounts, to what extent, those, it would yet make economic sense for them would also be something that needs to be considered. Overall, I think yet the volumes of Russian, steel coming into India is yet relatively small.
Okay, so not a big threat. The other geography from which there would be risk is, of course, China. We talked about it in a number of different contexts. And the question that is coming is, how will China's imminent ongoing housing crisis will have an impact on the Chinese steel market and to global steel prices?
So maybe I can go first, and I'm not sure if Ritubrata, Jayanta, and Priyesh have something to add. So, in his prepared remarks, Ritubrata also spoke about how the infrastructure spend in China is going to resume. So we also expect that the infrastructure spend, infrastructure investments will continue, will climb out around 10 odd percent. The other in 2022. The other sector that is a steel user is the automobile industry, where we also expect that the auto sales in the country would climb by around 2 odd percent over the previous year. Yes, there are downside risks from the property sector, and that those are key concerns. The inventory, the steel inventories in China have also climbed. I mean, they've gone back up to the start of 2021 levels, and therefore that's also causing steel prices to soften. So if you look month on month, actually, so starting March onwards, when steel prices were $800 in China, and I'm just looking at the domestic HRC price as a reference, the Chinese steel prices are already down, 24, 25 odd percent. So, and steel is a very regional market, right? There is not one global benchmark, but because steel can can move easily within the region, the Chinese steel price will therefore have an effect, I think, on the Indian steel prices. Each market that has different prices. I mean, when the Russia-Ukraine situation had emerged, because of the shortfall of steel entering from Russia and Ukraine into Europe, we saw European steel prices rise up to as high as $1,500, which presented an arbitrage opportunity for players from India included, as well as other Asian markets, to export steel into those markets. Now, with the export duties, that avenue is quite limited, and basically the regional prices are also kind of coming down. So all in all, I would say that China, being the largest producer as well as consumer of steel, also one of the large exporters, whatever happens in China will have an impact on the Chinese domestic HRC price, of course, but also on regional steel prices and on India.
Thank you. Anything to add, Ritubrata, on that?
No, I think also has been given a comprehensive answer. In terms of, just to give a number, this Chinese housing sector accounts for 15% of the global steel demand. So if there is a problem brewing there, it will have aftershocks. And what took the fizz out of the Chinese party in calendar year 21 was a default at Evergrande. And they've never really recovered. The steel demand has never really recovered post June, July of 21. So it's very important that there is structural resolution for the housing sector in China.
Yeah. There is an interesting question. I think we touched upon it a little bit in Case's response, which was, how will the rupee depreciation impact the Indian steel makers? Maybe Ritubrata, you can answer that.
Yeah. Let me try to look at three different angles. The first is on the cost side. So on the cost side, obviously, if you are importing something with the depreciation of the rupee, that becomes more dearer to you. So that would include coking coal, because almost all steelmakers are dependent on import of coking coal largely, and that accounts for around 50% of your overall cost. So the 3% depreciation of the rupee that we have seen in the last, since May, last 2 months, that obviously will have an impact. But on the other side, we are also seeing that coking coal prices themselves have corrected by 50%. So in a kind of, it has more than negated the impact of the rupee depreciation. So that is one point. The second point is with regards to imports, because with the rupee depreciation, what happens is imports become much more expensive, and to that extent, it gives an opportunity to the domestic companies, to give the importers a run for their money, especially for the commoditized grades. And to that extent, we are seeing, when we are forecasting that this year, the steel imports are going to trend lower compared to last year by around 10%. So that is beneficial. The third angle is with regards to pricing, because what happens is that steel is a globally traded commodity. It follows import parity pricing, and the rupee depreciation obviously gives flexibility to steel makers to kind of increase prices. So to that extent, net net, we expect that this is going to be beneficial for steel makers.
Thank you.
One
And
more
also, I
aspect, I
think,
think, yeah, sir, you can.
no, please go ahead.
Yeah, I was also trying to highlight one aspect, one additional aspect in terms of some of the balance sheets of steelmakers within India. We have seen that some of the steelmakers have forex debt in a large proportion of their overall debt levels. So if those forex debt portions are not hedged by some of these steelmakers, it could lead to large forex losses in the interim because of this rupee depreciation. So that one aspect, I think, would also play a role in determining overall profitability of steelmakers in the Q1 and Q2 period that we are going to witness.
Thank you. Okay, let me move to Casey. There's an interesting question on comparing JSW and Tata Steel and maybe even JSPL here. So the question is, in the current scenario, which steel makers will have better margins? Would it be the converters such as JSW, or the more vertically integrated players such as JSPL and the Tatas?
Sir, you would like to take that?
Yeah, Casey, I'm asking that to Casey.
Sure.
Yeah, so the integrated steel producers like Tata's would have a better control over their profitability in terms of margin. So as I said earlier, we expect that the profitability for Tata Steel would be slightly lower than the previous year. It will be lower by around 30% odd. So we are forecasting $100 odd of reduction in their EBITDA per ton. But given their backward integration into not just iron ore, which is 100%, but also around 21% odd for coking coal, they have a better bargaining power, in terms of absorbing, facing the challenges of, the softening steel prices. Now, the other players such as JSW, or for that matter, even JSPL, they do have some iron ore of their own, but because of their, the iron ore licenses are more recent, the kind of royalties they pay are, substantially higher as well. So inherently, actually, the cost of producing steel for them is slightly higher, and which is why Tata Steel continues to command profitability north of $250 odd per ton, whereas for JSW it is around 160.
Thanks, Casey. Yeah, I've got quite a few questions on the industry environment. Let us go through those, a few more of those, and then we would move on to questions on the capacity expansion, leverage, and funding that is also seems to be a topic of interest. So maybe go to Ritubrato on some more specific question on projected growth, year-on-year growth in finished steel demand in Q3 and Q4 of fiscal 23, Ritubrato. What's your expectation?
In Q1, we don't forecast a quarterly trend, but generally I can just give you some sense. Q1 we grew by around 10.8%, around 10.5% year on year. But this number is a bit misleading because Q1 of last year we had this devastating second wave of the pandemic, so especially in the month of May. So obviously there is a base effect which is at play. If you look at the growth quarter on quarter, Q4 of financial year 22 first vis-a-vis Q1, there is a decline of around 5% in the first quarter. Now, this is also a quarter wherein steel prices were kind of on a slippery slope, and our channel checks had suggested that many of the steel users were not keeping very high levels of inventory. So that had a role to play in this trend. But our sense is that any significant pickup in steel demand in monsoon may not be a realistic expectation. It's more towards Q3 and Q4 when bulk of the infrastructure spending is going to be back-ended during those 2 quarters. We expect a very meaningful pickup. So currently, we are doing an average monthly run rate of around 9.2 million ton per month. But we expect that from Q3 and Q4, that run rate should increase to around 10 million ton per month. And if we are able to do that, then we will end the year at around a 7 to 8% growth for the full year.
Okay. That's great. Thanks, Roberto. Let me move on to a few questions I've got on coking coal per se. I think one of the questions on coking coal is why has the prices dropped, and what would be the impact of cheaper imports from Russia? Casey, you want to take that?
I mean, typically the prices of coking coal and iron ore would, move in tandem with steel, right? So basically, since steel prices have also softened, and given other things remaining the same in terms of supply constraints, etc. So which is why I think coking coal would have dropped from north of 600 to then 400 to most recently around 250. Sorry, what was the second part of your question?
Impact of imports from Russia. How would that impact the coking coal prices?
Yeah, I mean, from what I understand, basically, steel companies use a blend of, of coal, whether it is from Russia as well as from Australia. So I'm not necessarily sure, how much of, coking coal imports do happen from, Russia. I'm not sure if Ritubrata or Priyesh have something to add there.
Yeah. So in terms of coking coal imports from Russia, I think what we have typically seen is PCI grade coal being imported by Indian steel players from Russia. Indian steel players usually prefer Australian grade coking coal for their consumption. So I don't think we would expect Russian imports of coking coal to increase in coming months. PCI import definitely that could increase if prices are favorable.
Thank you.
I just wanted to add one point here because, allow me, in terms of the first part of the question, why are coal prices dropping? Yeah, surely, as Casey rightly observed, that they are inherently strongly correlated with steel prices. I think one of the major concerns is also on Chinese demand. China alone imports, and Chinese share is almost 25% of international traded coking coal. And now Chinese production is dropping. They are down by 6% in first quarter. And even though this time there is no specific extent of production which has been announced by Chinese authorities, it's widely expected that because of the environmental issues, China possibly would restrict its output to last year's level, which in turn was restricted to the output of previous calendar 2020 levels. So that actually puts a question mark on the coking coal demand. And in the meanwhile, because of the very high coking coal prices earlier this year, a lot of additional supplies also have been streamlined, and they are now finding their way in the market. So everything put together, it's kind of a demand-supply overhang, a prospect of a supply overhang, which is having a role on the soft coking coal prices.
Thank you. Thank you, Jayanta, for that insight. Let me
seen that last, in financial year 22, most of the funding was done through internal accruals, mostly. This year also, it would be a mix of both debt and as well as internal accruals, because this year the free cash flows for the industry is going to be lower compared to 22, and that will not be adequate to fully cover for the capex. So to that extent, this year the debt levels for the industry will start moving up after declining for 2 years back to back. So broadly, that is the picture that we are seeing. But net, despite these capex plans that are lined up, with this 40 million ton that is committed, we are very certain, or reasonably certain, that the balance sheets of steel companies are going to stay quite healthy in the next foreseeable future.
Thank you. I'll get perspective from Casey as well on a question that is more specific to the two rated steel companies. And the question is, how do you see the long-term deleveraging for the two rated steel companies, particularly in light of high capex plans announced over the last 2 years? Additionally, leverage reduction for the rated companies seems to be primarily from EBITDA increase and cash accumulation rather than actual gross debt reduction. In case cash is used for capex, dividend, or acquisition, then would we actually see lowered or even stable gross debt?
Yeah, so there is a clear distinction in the way the Tata Steel balance sheet has performed over the last couple of years versus JSW. They've institutionalized a capital allocation policy that prioritizes debt reduction. So they've publicly stated that they will reduce gross debt by at least $1 billion each year, and then any surpluses would be applied towards, towards dividends and then towards growth capex. Between March 20 and March 22, so that is in 2 fiscal years, they already brought down gross debt by almost around 35%. And if we assume that they apply any free cash flow generation this year and prioritize that $1 billion towards reducing debt, they would have reduced the gross debt from March 20 levels by almost 45% by March 2023. So structurally, the balance sheet is very different. So for Tata Steel, the improvement in leverage is not just a function of the EBITDA expansion, but it's also a function of the numerator, because that has shrunk. In the case of JSW, you're right. The much of the leverage improvement is because of the EBITDA expansion. But we should also note that the debt has increased or broadly remained flattish or slightly gone up in fiscal year 2022. But they've also executed the BPSL acquisition. A meaningful change in the JSW operations now, as we see them, versus say even 3 or 5 years down the line, is that the scale has substantially grown. So now they are a company with 20 odd million tons of steel producing capacity, going up to 25 odd million tons. So even if there is an EBITDA erosion, EBITDA per ton erosion, profitability decline, that tonnage will help them. So you recall I spoke about how we expect that the EBITDA per ton will likely decline by around 35% this year, but on an aggregate basis, earnings are going to decline only by around a quarter, around by 24-25%. So yes, the debt is larger, but obviously their ability to withstand to face a downturn is slightly better. Now going back to the question on capex, therefore Tata Steel is in a much better position to take on more debt to fund any capex if they choose to do so. JSW already, the leverage debt to EBITDA was already 2.2 times. So it could, debt itself would climb. If in the instance that capex continues to be planned, to be executed in the manner that initially expected. But I go back to what even Ritubrata and Priyesh said earlier, was that these companies yet have the levers, right? I mean, they could scale back capex. We've seen that happening in the past, where they'll push out capex, or much of the capex with the cash payments could be back ended. They could focus on some of the subsets of the capex, capex projects that are towards improving raw material efficiencies, improving the operating efficiencies of plants, as opposed to just adding new crude steel capacity. So I think those are some of the levers that they would have.
Yeah. Thanks, Casey. Let me see. we can move on to something separate. So there is clearly a question or few questions that are relating to the decarbonization. I think that's an important topic that everyone is concerned about. With the steel sector, clearly the carbon consumption is a big part, and carbon emissions, of course, has to be reined in. But what are the major hurdles to decarbonize steel sector in India? And I think a related question to that would be, what are our views on the scrap steel market growth and trajectory of electric arc furnaces in India? Casey, you want to start, and maybe we go to it a bit after that.
Sure, sure. So, I mean, it's quite evident, of course, that that a blast furnace would have carbon emissions that are much higher compared to an electric arc. But I think one needs to also look at whether you're comparing like for like. So an electric arc furnace producer would have lower scope 1 plus scope 2 emissions, but then if you add scope 3 in terms of where the electricity sourced from, and unless that has a sizable amount of renewables, then obviously their scope 1 plus 2 plus 3, those metrics may not necessarily be fine. Now, in the case of India, I would think that the one is, of course, the availability of scrap, right? We don't have abundant availability of scrap. Scrap would need to be imported, and there's just not that much scrap available even in the global market. So to transition from blast furnace to electric arc, therefore is going to be challenging. The second is that iron ore is yet available in abundance and cheap in India compared to the global markets. You would recall when I was talking about the prices of steel, iron ore, and coking coal, I made a comment that the iron ore prices in India don't follow import parity pricing, and iron ore prices in India are determined based on the local markets in terms of at what price an MDC sells iron ore, and there is abundant availability of iron ore. Many of the players are backward integrated, such as Tata, for instance, and JSW and the others have also acquired mining licenses to be better integrated. So that's not really an issue. Then the issue really is how quickly, how fast can they transition to an electric arc, and the regulatory environment in India is not as stringent, in terms of requiring steel makers to transition to EF. So I think and neither are customers. Not our customers insisting on, steel to be sourced, which is produced from green routes. Not sure if Ritubrata, if you wanted to add anything.
Yeah, just two quick points, which we are seeing as immediate. Some of the trends that are evolving. One is a replacement of grid power with renewable power. So we are seeing a lot of steelmakers across the secondary to the primary. They are, setting up captive solar/wind power plants, where the cost of generation is much more competitive. Let's say between 3 to 4 rupees. Vis-a-vis, if they have to draw power from the grid, it is between 7 to 8 rupees. So it's giving them an immediate payback. And these kind of projects are happening thick and fast in the Indian context. I think most notably, ArcelorMittal has signed a very large, agreement with Greenco on this front. The other trend that we are seeing is bigger is better, not only in terms of efficiency, but also in terms of carbon intensity. So most of the larger, furnaces that are coming up in India, those are larger furnaces where, the efficiency parameters are also much better. So that is also one trend we are seeing. Yes, in terms of scrap, that continues to remain a challenge, scrap availability, because we don't have those supply chains available. Most of the scrap segregation and aggregation is the informal sector is doing it. So that will take some time before, scrap availability becomes much more readily available than it is today. Jayanto, Priyesh, you would like to add anything?
I think one aspect that I would like to highlight is that the kind of capacity expansions we are going to witness in next 5 years, as Ritubrata highlighted earlier, almost 40 million ton. Entirely, it would be a large part of it, at least, would be in form of these blast furnace routes only. So, at least in next 5 years, we are not going to see any major ESG kind of initiatives being implemented by steelmakers. But yeah, renewable energy definitely is the most preferred route right now for most of the steelmakers.
Okay. All right. The other aspect that is interesting to talk about is industry consolidation. And, what is, we have seen a few transactions go through, whether it was distressed assets being sold. Are we looking at more M&A activity in this sector by Indian companies? Maybe I'll start.
You would like to take up discussion?
No, maybe I'll start with Ritabrata on this one.
In terms of M&A, we have seen most of the distressed assets, most of them have changed hands, most of the larger ones. What is left on the table is not very, I would say that let's say sub 1 million ton kind of capacities. Most of the 1 million ton plus capacities have changed hands. So that is point number one. The other thing is that, consolidation still is going to be a theme, because if you look at the capacity that is getting added in the foreseeable future, most of it is coming from the top 5-6 players. So to that extent, if today, as we speak, if the top 3 players are contributing around, or top 4 players are contributing around 40 to 50% of the overall production, if we fast forward 5 years down the line, that number is definitely going to increase, just because of the fact that they are the ones who are building in bulk of the capacity.
Right. There's a related question on that in terms of the government has a privatization program in place. Will Steel Authority of India be put on the block? Who want to take that?
Okay.
Let
me try to share my thoughts. Steel Authority of India, with a total capacity base of what, almost 21 million ton, and a lot of mines attached to that, would be a very large investment plan if anybody wants to. I'm not sure who, if we use a benchmark of 1 million ton requiring $1 billion of investment, or even if we scale it down to anywhere between $750 or $800, it's going to be a huge investment proposition for anybody. And who can be the potential acquiring company? Look at all the biggies, as we have been discussing. Everybody has their own capex that they have announced or in the process of acquiring companies. Let's not forget that another large capacity in the form of Rashtriya Ispat Nigam and NMDC, these two together would be another 10 million ton. They are already on the blocks, possibly. So after that, who can be the target company or potential investor who has the financial might to even bid for Steel Authority of India? Now, whether this can be sold out, not as a whole company, but different assets, because they have a number of plants. Whether that is on the agenda of the government, I am not really aware of that. Whether international companies, they want to make inroads to Indian market, something that ArcelorMittal and Nippon had done when they acquired SR Steel, that remains a possibility. But if steel industry has to go through a prolonged downturn once again, even they would have cash flow related issues, and there may not be any ready buyer available. Anything, Casey, Ritabrata, Priyesh?
Nothing further to add. Of course, POSCO, for instance, has been wanting to enter the Indian market as well. They've entered into an MOU with the Adani Group, but that was to enter through the organic route. But as Jayanta rightly pointed out, in terms of where we are in the steel cycle, and all the steel companies facing challenges in their respective home markets, there's going to be strain on their own free cash flow generation. The question is, who would be looking at a large M&A at this point in time?
Yeah. Okay. Looks like we are largely done with the inorganic strategies, and those have been executed. Looks like very little. One thing I can add is, it will be less challenging to sell Steel Authority than BPCL. because of the regulatory issues. Okay, let's move on, continue on. We have a few more questions. There are certain questions that I'm not posing to the panel because these are questions that we can take offline and send answers to. There is a question on the decarbonization as well. Just in terms of relative ranking, KC, are we able to maybe see who's relatively better positioned on the decarbonization?
So we did launch carbon transition assessments, which is a product that we have, and we launched the CTAs, or the carbon transition assessments, for the steel sector last year. And just because of the nature of some of the blast furnace producers, the ones that had entirely blast furnaces were weakly positioned. So to put things in perspective, the two rated steel makers, we do have CTAs. We have a JSW, which is slightly scored better compared to a Tata Steel, also because they have a 5 million ton electric arc furnace in the United States, whereas Tata Steel's entire steel making capacity is through the blast furnace route. And then JSW also have some modulations in terms of the way they produce steel. They also use DRI. And they have a higher use of scrap as well in the steel making processes. So that's all I can add. And we can send across the CTA framework as well as the the scores that we have following this call.
Okay. Anything to add on that from anyone? Okay. Let's move on. So there are a couple of questions that I wanted to get through. One was relating to our presentation, where the question is about the capacity utilization of JSW that we are showing. We're forecasting a high utilization in 23 versus 22. And the question is, what is driving this, especially in light of export duties being put on and them taking a maintenance shutdown? Or advancing that maintenance shutdown. Maybe whether this is relating to your slide.
Yeah, I think it was pertinent to a slide, but we didn't make a comment specific to JSW. What we said, or what we are saying, is that in financial year 23, the total capacity that is going to come incrementally is only 3 million ton. So that's the incremental capacity. My production growth for financial year 23 obviously is going to be a bit lower compared to what it was last year. But despite the fact that the production growth is lower, just because of the fact that the incremental capacity that is getting added is only 3 million ton, we are expecting that the steel capacity utilization level to increase from 80% last year to around 82% this year. And within that, why we are expecting the increase is that despite that exports will be lower, finished steel exports to be lower by around 25%, but semis exports we expect to be higher by around 40% compared to last year. So that's where we are arriving at the 5% production growth overall for the full year.
Okay. Thank you. The next question was with respect to the overall trend on overall trend of sales volume for the large integrated steel players in 23 compared to 22, considering that the export volumes will be lower. So what is our expected trend on total sales volume? Is that in line with what you were saying, Ritu, 80 to 82%, that's capacity utilization, so we will still have sales growth?
Volumetric, I think we have a number for in terms of consumption growth, which is around 7 to 8%. Now within that, obviously the growth for the primary players would be higher, because we are saying that the secondary players, especially the smaller ones, are currently going through a rough patch, especially the way thermal coal prices, imported thermal coal prices have behaved, and their margins have been very severely hit. For them, the respite has not yet been visible, unlike in coking coal. So to that extent, within overall, the industry volume growth would be around 7 to 8%, but the integrated players could see a better growth compared to the secondary players.
Okay, I think that's pretty much all the questions that I had that we could answer. Last call from people attending. If you have any question that you would like us to answer, please send that through the Q&A box. We have a few more minutes. Okay, just got one more. Okay, let me just say. Okay, there's a question on will we share the PPT. I'm sure we will have some instructions after the webinar that you will receive on how to get the PPT. So yes, we will share the PPT. Okay, the question that have come in this in the last few minutes, we've got question on inflationary trend. Will the global inflationary trend have any major impact on consolidation that has taken place in the domestic steel industry, and will it prevent further fresh investments? It's something that we have answered, but maybe anybody would like to reiterate the point on consolidation or in terms of capacity expansion. I guess long-term demand drivers still remain intact. Yeah. Mr. Bhatta, anything to add there? Any impact from global inflationary trends?
No, I think inflationary is a temporary phenomenon. Consolidation is much more of a structural story.
Yeah.
So to that extent, we should not mix both of it. Obviously, inflation will have its impact, but I don't think that it is going to, kind of jeopardize the consolidation story, which is a more longer term. And in India, if we compare the top three, the share of the top three, vis-a-vis, let's say, some of the advanced countries like Japan, where the top three players contribute around over 90% of the nation's production. So obviously, we are somewhere between Japan and, let's say, China. China, obviously, there's much more deconsolidated industry. But let's say compared to US or compared to Japan, we are still significantly, top three share is significantly lower.
Okay. Anything anyone would like to add, or any points to be made that we haven't covered? Jayanta, Yesh, this has been very, very comprehensive. We've talked about a number of different aspects. If not, maybe I will just thank everyone for their participation and questions. There's some information that has been asked for in some of the questions, which we will get to through email after following this webinar. You'll also get instructions on how to get the PPTs. Any final thoughts from anyone? If not, thank you very much, everyone. This has been extremely good. Thank you. Bye.
Thank you.
Thanks everybody.